You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back. It is time once again for the Advisor's Option, the program here on the network where we bring some news, some information, some analysis, and indeed some education to the table for you, the busy financial advisor. Maybe you're intrigued by these options things, but you've been a little bit too intimidated to take that first step. Maybe you've been diving deep into the options waters. You want to arm yourselves with a little bit more information and education. Whatever the case, we're here for you on the Advisor's Option. My name, of course, Mark Longo from theoptionsinsider.com, as well as on the network upon which so many of you are binging, the network that continues to grow. Just got off one of the newer additions to the network, the European Market Brief. 3 new shows hitting the network in the last 6+ months. Of course, the Futures Rundown, and then the newest edition just hit a few weeks ago, the Hot Options Report. So yes, 3 new shows heading the network. Yet another reason why, if you're not subscribed to the full network, you are missing out on a boatload of content. Of course, if you're ready for it, ready to go above and beyond, make sure you check out the Pro. Congratulations to our Pro member, Mr. Unlimited, for winning the July Pro Trading Crate. If you want to join him, maybe get your name in the hat to win the August Pro Trading Crate, check out Options Oddities every week, which Matt has been on once or twice or a few times, as well as, of course, Pro Q&As, all sorts of fun stuff, exclusive live streams, exclusive shows, the optionsinsider.com/pro, the place to go to learn more as we learn who's joining us on the old Advisor's Option program this month. I just mentioned him. He's back once again, our good buddy, Mr. Matt Amberson, the founder over there at ORATS, although he's known around these parts as the Otto father these days, the creator of everyone's favorite rogue AI. Mr. Matt, welcome back to the show, sir.
We have a new Otto in our dashboard, Mark, that is very popular, getting rave reviews. We have a beta version that was oversubscribed. So there's a lot going on at ORATS, and look out for Otto coming to a computer near you.
Does he come complete with the blinking, glowing red eye so you know that he's menacing right out of the gate, Matt?
You better be nice to him because they're taking over.
Otto's lurking behind my shoulder. I'm always watching out for Otto here on the network. And you know what? If one Matt wasn't enough, how about if we square it and add a Matthew? We are joined for the first time on the program and indeed on the network by Matthew Tuttle, the CEO and CIO, double duty over there at Tuttle Capital Management. Matthew, welcome to the Advisors Option Program and indeed to the Options Insider Radio Network.
Thank you for having me. Great to be here.
And Matthew, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our audience a bit of an overview of your background in the world of options and derivatives, as well as what it is you folks do over there at Tuttle Capital Management.
Yeah, so I run Tuttle Capital. We're an ETF shop. We've got somewhere in the low 30s of ETFs. We just launched like 4 more, so I lose track. About $4.3 billion. We are known right now for our T-Rex ETFs, which are 2x long, levered, and inverse single names. But we are making a massive push next month into all sorts of interesting option-based ETFs. You know, I trade options personally. I love options. We teach investors something called the heat formula: hedges, edges, asymmetry, and themes. And using options within that formula really turbocharges it quite a bit.
All right, then we have a lot to get to. It's going to be an exciting buzz, but before we get there, let's kick things off with the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement, the segment that was born of the pandemic because we spend so much time at the top of every show just saying, what the hell just happened every month, that we decided to make it its own part of the show. And thus, the P&L statement was born. So Matthew, as our guest, we'll start with you. Obviously, a lot going on in these markets. This is normally the quiet seasonal period for the markets. Not a lot of volume. Markets are pretty thin heading into August. Vol is usually pretty dead. Usually this time of year, there's not a lot to talk about, but these markets are not really like any others we've all been through. We're all still hanging out in this lingering trade war. Is it on again? Is it off again? At any moment, a tweet could come out of the White House that changes the entire game. So not quite the same summer doldrums as we're used to. That said, Matthew, what is catching your eye and lighting up your tape out there right now from an overall market valuation or vol perspective, sir?
Yeah, so this market, I would argue, is completely different. It's been a change that's been going on and kind of morphing since COVID. But I think you've got kind of 2 things going on. The Wall Street Journal wrote an article, I think like 2 days ago, about a new generation of buy the dip investors who weren't around in 2008, like I was, also 2000 and 1987, so on and so forth. And, you know, that's changing the nature of sell-offs. Then you've got the fact that this market really is thematic, and you've got to be paying attention to these themes. And President Trump has put that on steroids. So you've got stuff like, you know, the nuclear announcement that just happened today. You've got what's going on in drones, robotics, all different areas of AI. I just think, you know, could the market be overvalued? Sure. But this is entirely different than what we've seen. And you've really got to be focused in on those themes.
And obviously, it's not usually the most scintillating time of year from a vol perspective. Anything catching your eye out there from a general vol perspective, sir?
Yeah, I mean, normally I like to buy puts on the VIX exchange traded products. Number one, because volatility tends to go down, and number two, those are awfully designed products. So it's been great for that trade. I mean, we like to buy volatility spikes. So it was a Jobs Friday where volatility spiked. So we're buying puts. Volatility is dying. I always, part of the heat formula, H is for hedges. I always advocate people having hedges. I normally like buying VIX calls or VIX call spreads or VIX ratio spreads. I don't have any yet, but I'm probably getting close to a point where I'm going to want to add some VIX to the long side, not because I think VIX is going to spike, but just because it's cheap protection. And when protection is cheap, I like to buy it.
Has been an interesting time to fade some vol, including today. Vol getting taken to the woodshed yet again today off a fairly decent, I suppose, maybe not as bad as expected, CPI number out there. So a lot of interesting stuff on the docket. Mr. Matt, you were just saying to us on vol views recently, you're always a little dubious of this market, I think it's fair to say, but maybe you're a little bit extra dubious, a little bit more dubious these days. Is that still the case? What is catching your eye out there, sir?
Well, you know how I love my acronyms, and so I'm loving this heat formula.
I was going to say, we're full of acronyms on the show today.
Yeah, so hedges, edges, asymmetries, and themes. I love those. So congratulations to Matthew on bringing that in. Yeah, I'm looking at a few things. So I avoided the market today because we had, CPI, and the market was really expecting or had about 60% more volatility in today. But the biggest day is going to be Friday. So this is an interesting look to the skew. So, what we do is we have a very good way of looking at the S&P 500 volatility. And we kind of watch what day is the big day. And you could kind of, in our graphic, you could see it kind of climbing towards us ominously. So Friday's the big day. And, there's not that much going on Friday. There's retail sales. Like we have this macro calendar, and there's a lot of little things happening. Exports and retail and capacity utilization, inflation expectation, Michigan is announcements and such. But so this is interesting. So I'm wondering why Friday. So investors watch out for Friday. Be hedged, as Matthew might say. So I'm seeing that. And then, I'm seeing volatility completely coming out, as Matthew mentioned, of the market. So, we have an outlook page that looks at, not only implied volatility, which is low, but implied volatility, for example, in S&P versus the component weighted averages. And the component weighted averages usually is a certain percentage of the S&P, or the SPY might be a percentage, might be 60% of its weighted average of the component. So in a market in duress, everything goes towards one. In a market where there's benefits from diversification, the healthy markets, that ratio goes down. The asymptote is kind of like 40 under 50, in which it is right now. So there's not a lot of fear in the market. We look at it a few ways. Contango is way up. That's a good thing for the market. Backwardation is bad for the market. That's the term structure. Front month is very low compared to the back month. And then the puts versus the calls, that's about mid-range. So in general, there's not a lot of worry out there, Mark. I'm always worried because I'm an ex-market maker, and we have to be worried to keep our jobs all the time. So, I agree with Matthew. This is a time to get some protection. I'm doing put calendars, long-term put calendars, because I don't want to just buy flat-out puts right now, because it's, Trump was the single-digit president the first term, and who knows what can happen again. So the calendars will give you, aren't as kind of risky in that. So that's what I'm seeing now, Mark.
All right, listeners, and let's keep on rolling, diving on into another segment that was born of the pandemic. It is time for the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the earnings volatility report.
All right, welcome to the earnings volatility report. Like I said, another segment that was born deep in the heart of the pandemic when we started saying, man, this earnings vol is just getting taken to the woodshed. No one cares anymore. And thus, this segment was born. We've been crunching this data for a while. If you want to check it all out for yourselves, of course, head on over to the website, theoptionsinsider.com. Click on the Options News and Articles tab. You can go back to before the pandemic times. Check out all the earnings vol data we've been crunching out there for you completely for free, because I guess we really like you folks at the end of the day. And Matt, this is a good time to talk about a little bit of earnings vol, because we are in it. We are in the teeth of earnings season. Big names popping off left and right. A lot of market moving announcements going on out there. Let's start it off. Look back on last season. If there's any particular highlights or lowlights that caught your eye, have at it. Then B, what's catching your eye as we tear into yet another, looks like so far, pretty explosive earnings season, Matt?
Yeah, so you're right. We've talked about this for many moons, and we actually together developed some of these reports. Not just the report that shows each individual stock, but that looks at each week of the earnings season. So about 6 weeks to an earnings season, that's when most of the stocks would report. This one started about the 11th of July. Now we're a month in. So we're technically in week 5 here. And what we see generally is, the first week, those companies aren't generally that volatile, and they're aptly priced. So there's not much benefit of owning straddles. That's what we usually see. It's not always the case. As a matter of fact, lately that has been the opposite of the case. But what we really see, the thing that we've learned that's counterintuitive, is that when the volatility is low in the overall market, the earnings effects, or the earnings move versus the expected moves, are greater. So people are paying more attention to earnings, and those that own straddles when the volatility is low in the market generally do better than the opposite. And that's kind of what we've seen this earnings season. Volatility has been low and overall, and owners of the straddles have done a lot better. So we put a percentage on them. It's usually right around 100%. Through COVID, it was got down to the 80s. And this is a big one. This is 131%. So 31% to the positive for owners of the volatility. So in the past 12 earnings seasons, it's been over zero. It's been 119. So that's quite something. But before that, it was lower. So, we crunch all the numbers. We look at all the earnings. We try to put them together to get a feeling for what's going on in the market, to get a feeling for our intuition about when it's a good time to buy vol around earnings season and when it's a good time to sell it, especially on the individual names. And yeah, that's what's going on in earnings now, Mark.
Matthew, how big of a driver in your system is earnings season, and what, if anything, is catching your eye out there as we embark on yet another round, sir?
Yeah, so it really isn't a big part of what we're focused on. I don't typically play earnings unless I'm just seeing something that makes it make sense to take a stab. That's rare. Back when I had more time and I was actively trading, which I don't have time for now, I would actually completely avoid earnings season. So if a stock had earnings, I'd sell before and buy back in later. Now that we've had to adopt more of a longer term approach. I'm holding stocks through earnings. Certainly been a very good earnings season for us for some of the thematic names. One of my favorite has been a drone stock, ONDS, which is ramping on earnings today. That's been a lot of fun. But it seems like this has been a really nice earnings season across the board. A lot of the AI stuff we wanted to see about CapEx, which I think is going to be extremely important to this market, came out the way we wanted to see it. So, not seeing anything here that would concern me.
All right, listeners, and now it's time for us to keep on rolling, and you folks maybe take the reins, a little bit of your Options 101.
It's time to learn how to use options to manage risk and generate additional income for your clients. It's time for Options 101.
Welcome to Options 101, the segment here on the show where we delve a little bit deeper into particular options, strategy, or educational topic and explore how you can utilize it in your clients' portfolios. And I feel bad, today's segment was actually inspired by a listener question. Of course, we had to move the show. I was struck down right before we recorded the show last time, listeners, with a vague and terrible illness. So we had to bump it. So he's been waiting patiently for his answer. This question comes from Penta Driver. Better late than never, we're getting to you. It says, hey guys, I love the AO show. Well, right back at you. We love all you folks out there who take the time to listen and rate and review and write in and everything else that you do. He said, my question, we're heading into summer. Obviously, we're kind of coming into the tail end of summer now. Like I said, got a little bit delayed on answering this, but again, better late than never. We're heading into summer and vol is trending lower. I know you always say not to sell vol when it's too cheap, to make sure that the, quote, juice is worth the squeeze. That sounds like something I would say. And my question, how do I tell when that is the case? Are there easy metrics to know when I should not be selling a certain vol level? Well, short answer to that is yes, there are quite a few ways you could tell when you're maybe selling a vol level where the juice is not worth the squeeze. One of the ones I like the most and one of the most readily available, you can usually find it in just about any decent brokerage platform or analytics suite out there. These are volatility cones. Again, pretty straightforward. They show you the realized, aka historical vol levels for a particular name going back for any period of time you want to look at. And it'll show you, when vol is historically high, 1 or 2 standard deviations above the mean, 1 or 2 below. So you can tell if the vol level you're currently trading is 3 standard deviations below its historical mean, then maybe you might want to be a little bit judicious about hitting that bid and vice versa, buying it when you're 3 or 4 standard deviations above the mean. Now, that said, there's obviously outliers to all of this. When vol is high, sometimes that is a time you want to buy it, and vice versa when vol is cheap. As Matt said, last time Trump was in office, vol got to single digits, and the best move was to sell it because it sat there forever. So sometimes vol can be cheap for a while as well. But at the very least, that's one very basic, easy, readily accessible tool that anyone can use to see where your vol sales are stacking up from a historical vol perspective. That said, Matthew, same question for you, sir. When you're looking at your vol sales, what are some analytics or metrics you use to see if perhaps the juice is worth the squeeze, sir?
Yeah, so we're not looking at that as much. What we're telling people more to do is come up with a couple of different option strategies you're comfortable with, and don't try to get too cute with it unless, again, you're sitting here all day, every day looking at it. So for me, outside of our hedges where we get a lot more sophisticated, I like to have a combination of cash secured put sales and outright call buys. Going back to the whole heat formula idea, when I buy a call, to me, that's an asymmetrical trade. My downside is known, my upside is unlimited. But when I'm selling a put, that to me is an edge because most of the time the market's going up. If I know what I'm doing and reading a chart and where I want to put the put, most of the time I'm not going to get exercised and I'm just going to collect that money. And I want a mix of those things in my portfolio Now I'm going to ramp that up and ramp that down, not as much based on volatility, but more based on where I feel the market is. I kind of look at it like, cards, blackjack or poker. When you're seeing the odds in your favor, that's when you double down and bet big. When you're not seeing the odds in your favor, that's when you're cutting back. So that's more along the lines of how I like to look at things.
Mr. Matt, same question for you, sir. You're always, you're crunching and creating tools over there all the time. Penta Driver wants to know, are there any easy metrics to know or he should be looking out for when he's selling vol to maybe realize that the juice is perhaps not worth the squeeze, sir?
Yeah, so as you know, Mark, and many of the listeners know that ORATS is known for our backtesting, and we've published right now on our site, we have over 300 million pre-canned strategies. And one of the rules of thumb or intuitions that I've learned from the backtesting is they don't get the vol high enough and they don't get the vol low enough. And what that means is when the vol is low and going down, market makers, of which I used to be one, don't lower it enough. So sometimes in these types of situations, our backtests are showing that, it still is a good time, with the right strategies, the right risk management, all that, to have some short vol. So, and you could also have short vol with some protection. So it's not intuitive, but those are the things that we look at when we're backtesting. And you could always backtest your strategies in these certain environments. So ORATS does a lot of backtesting in certain environments. We also now have a indicators backtest, so we could choose certain strategies and find out optimal entry and exit points based on, volatility levels or whatnot. So, and what are coming up as important indicators, which is great for us, it's our forecasts, in some cases, how our historical volatilities are matching up with close-to-close volatility. So we use a modified Parkinson historical volatility, which is a little technical, but sometimes that gets out of whack with the close-to-close, and that has some indicative value, as does the forward volatility, flat volatility calculations. That's a little bit too long to get into in this call, but we look at a lot of those types of indicators. So yeah, you definitely want to be looking at indicators. You definitely want to be looking at volatility backtests at levels and seeing how your strategies perform, Mark.
Backtesting, another good tool to take advantage of over there at ORATS or wherever you like to do your backtesting over there. Who was that? Penta Driver, but definitely another tool you should be taking advantage of. There you go, kind of cheating, bumping that up from the office hours, but it seems like it merited its own segment. He's been waiting patiently, so we didn't want him to wait any longer. As we keep on rolling with the show, listeners, it is time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz, the portion of the show where we break down all of the big stories, developments in the world of options and derivatives that have occurred since our last show that maybe you weren't aware of because you're busy actually dealing with your clients. And the big story, the one we've been talking about for a while now, the kind of ongoing trend that is consuming all things options, is this just incredible growth story in the world of options and indeed in the options market. This thing has been growing seemingly endlessly ever since really the early days of the pandemic. There were a few hiccups in there, a few moments where maybe it seemed like, okay, this is it. The tsunami is finally coming to an end. And then lo and behold, we roar back out of the gate again. We do have the numbers now for July from our friends over there at OCC. And was July yet another banger? The answer is yes. You know, it's getting to the point where 1 billion contracts a month, that used to be just an insane, just ridiculous number. Now, if we don't get north of a billion, even 1.1 billion, it's kind of sleepy. In fact, July of last year, normally a quiet time in the market, 1.1 billion contracts, blew that away again this year, 1.23 billion contracts on the tape. So close to 1.25 billion contracts going up in a single month now in July. Again, not usually a banger period for the market. That is a little over 12% increase from what we saw this time a year ago. Again, let's drill down a little bit deeper, see where that growth is coming from. Interestingly enough, not in Matthew's neck of the woods this time. ETF options overall mostly flat, up about 1.9%. And then we saw index options that have been a big engine of growth over the past few years, especially as we've seen this just all things zero DTE bonanza just engulf the market. They were pretty strong, but maybe not quite as strong as you'd expect, up 8.4% year over year. So where did the lion's share of that growth come from? It was single name equity options, kind of old school. Going back to the old times there, listeners, single name equity options volume up nearly 21% year over year, 20.6%. If you're looking for a dark spot, we have been talking about this for a while. VIX futures, from a volume perspective, just cannot catch a bid, off 33%, fully a third year over year. So a rough time to be in the VIX futures business. We've been talking about that a little bit with our good buddy Dr. VIX on VolViews recently, and about how once VIX hits some near dated highs, it does seem to really hit the volume for quite some time, and that appears to still be the case out there in VIX futures land. Only 3.9 million contracts changing hands in July, but otherwise just an absolute banger month. Again, nearly 1.25 billion contracts going up in what is otherwise normally a sleepy period out there. Matthew, we'll start with you. I'm sure you have some thoughts on this issue, and just in general, the ongoing juggernaut that is the options market these days. What are your thoughts on these just ridiculous numbers? And at this point, is there anything you think that can derail the beast that is the options market, sir?
I think the exact opposite. I think you've got a new generation of investors who are embracing options like never before. And we're seeing things like what just recently happened with IBIT, where they expanded the amount of options you could trade. They also allow flex options now on IBIT. That was a big move. And that's in keeping with the SEC's more and more adoption of crypto. What you're also seeing is, I know that the NASDAQ has put in for Monday, Wednesday, Friday options on a number of single names. The sense that I am getting is that's going to happen. When, I don't know, but the sense I'm getting is it's going to happen. My guess, and no one is telling me this, it makes sense, is that we'll see zero DTE. You take all of the weeklies that are trading a lot, that will eventually see zero DTE on those. They'll go to Monday, Wednesday, Friday, and then we'll add Tuesday, Thursday. So I just see options being bigger and bigger and bigger. And then you've got guys like us who are doing it on the ETF side. That just feeds into it even more. The more assets that go into the option-based ETF strategies, that's going into more options, creating more demand.
It has been fascinating to see the ebb and flow into what's really driving the growth. Early days of the pandemic, it was single name equities, a lot of retail flow coming in, driving that. Then we saw a shift into the indexes and zero day, as everyone was obsessed with zero day. Indexes were driving everything, and single name equities were kind of flat year over year. And then we saw ETFs kind of kicking in, as you mentioned, a lot of defined outcome funds and other things using options in a lot of different ways and driving a lot of flow there. So it has been fascinating to watch. And it seems like, at least for this past July, the pendulum swinging back to old school single name equity options, driving the ship out there. Matt, same question for you. This has obviously been a trend we've been analyzing for some time out here. It continues to grow unabated in July, sir. What are your thoughts?
Well, I'll speak for my firm. We deal with a lot of different types of entities, from retail to the biggest institutions, and everyone's kind of coming for it. We've had record, like 4 record months in a row, with the biggest one being July, and it's continuing into August. So, we sell data. I think a lot of it's AI, a lot of it's, they need our data for their AI platforms, and we're seeing just a ton of more people looking for data. A lot of people are really liking the platforms themselves. So there's just a lot of interest in options trading. So it's trickling down to ORATS, definitely. And, I haven't seen anything like this. Like it's, we're kind of waiting for a chance to catch our breath, and it's not coming. As you said, it's into July, August, and still going strong. So, there are people that are, learning how to trade options, learning how to use all this technology, learning how to use AI, and they're trading, and there are more coming after. There are waves of people coming. So that's what I'm saying, Mark.
See, Matt, trickle-down economics can work. It just took, 40 years, and then it's working here, at least in the options market out here. But since we're talking the buzz and some interesting new developments, and Matthew, you mentioned some of the stuff you're working on over there at Tuttle, I'd be remiss if we didn't bring those up now, because I think a lot of those might be intriguing, especially for the core audience of this program, the financial advisor, asset manager out there. A lot of them like options, a lot of them are intrigued, but also don't have the time or perhaps the expertise or the wherewithal to do it themselves. So a lot of these options-oriented funds can serve that purpose out there. You mentioned 0 day. We'll start there because it is still kind of the hot thing in town. I'll have to check in. I know I talked to a lot of those folks down at OIC a few months ago, NASDAQ included, about that proposal. I haven't heard much since, so hopefully that is moving along. That would be certainly an interesting development for the single name 0 day front. But right now, obviously 0 day, mostly focused on the indexes. What are you folks cooking up on the 0 day option front over there at Tuttle, sir?
Yeah, so we already handle all the administration and trading for T-SPY, which is a S&P 500 0 day. But what we're launching September 23rd, actually, are 0 DTE ETFs on MicroStrategy, Tesla, NVIDIA, and IBIT. But we're doing that, except on Fridays, through flex options. So that's going to be operationally a lot of fun, but, give investors exposure to a 0 day product, which in my mind, I'm not a big fan of covered calls. To me, that's not an asymmetrical trade because you're giving up some upside. You're not really limiting your downside. Just, my feeling on that. But I do like 0 DTE from the standpoint of you're still getting those overnight returns. And every day you're able to make a decision on what you want your strike price to be. So that's what we have coming in the 0 DTEs. And then hopefully the regulation will come to me and I'll have listed options to trade on those names. But until then, we'll just use flex. I have a great business proposal for Matt. Become a data provider for flex options, because there is, as far as I know, and if I'm wrong, hit me up, there is no one data provider for flex options. All the market makers, all the traders are combining kind of multiple things to try to trade in the flex option market. It just seems ripe for someone to come up with Bloomberg for flex. But yeah, and again, maybe it exists and everyone I've talked to just doesn't know about it, but it doesn't seem like it.
There you go, Matt. Have you delved into the flex waters at all over there at ORATS, sir?
Only as a market maker. No, I mean, it's actually quite difficult to get at that data.
I know.
Yeah, and so, but yeah, I mean, I agree. There is a demand. I hear questions about Flex every so often.
I can count pretty much in the last year and a half, the number of people who've approached us all of a sudden, hot and bothered about Flex is exponentially higher. We stopped talking about Flex years ago on the network because no one cared. It was very deep in the weeds, arcane minutia, and now all of a sudden, with all these funds looking to convert, let's say, their exercise risk, or perhaps in the case of Matthew, looking to add different days to the expiration calendar that don't exist. There's a lot of use cases for Flex. In fact, our buddy Henry over there at Trade Alert, he just recently started adding the Flex. When you do a regular scan, the Flex just comes up along with all the regular listed trades now. So it's all just included. It's all just data there at the end of the day. So Flex is becoming more and more relevant. If you're not sure what we mean, listeners, check out some of the archives of this show or the other ones. Flex, obviously, just really at the end of the day, custom options contracts where you could set the month, the strike, whatever the heck you want out there. And again, usually it's for larger institutions, not really for retail, which is why we don't talk about it too often. But it is becoming more and more flexible, pun intended, out there. So I expect we'll be hearing more about Flex. And speaking of hearing more about stuff, since we're talking about some of your cool new offerings here, Matthew, maybe we got some advisors out there in our audience who want to get a little bit more dangerous. They want to roll the bones a little bit. And for them, traditional names like CoreWeave or SMR, you know what? They're just too boring. They want to get a levered bite at the apple. What do you got for those folks, sir?
Oh, we got something for those guys. Yeah, I mean, that's our specialty is 2x levered and inverse. We're doing it on the names that people want to trade. So we just launched a bunch of them. 2x CoreWeave is one, 2x Galaxy, 2x Webull, 2x DraftKings, 2x SMR. Our biggest is 2x MicroStrategy, MSTU. Our second biggest is 2x NVIDIA, NVDX. We got Robinhood, 2x, ROBN. So we've got, again, I lose track. We keep launching them, but we've got about 30 of these names. And, definitely if you're looking for a higher octane, that's where you want to go. And all of them should now, I know we just launched options on a few. All of them should have listed options as well. If you want to trade the options on the levered, even better.
There you go. Music to the ears of a lot of our listeners. Speaking of our listeners, we got a few minutes left. So let's open up the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
Welcome to the office hours, a portion of the show where you folks take the reins, your questions, your comments. A lot of you have sent in some great questions. Of course, if you're hanging out in the pro listening live, you get bumped to the top of the list. So we got a question coming in here for you, Matthew, from our crate winner, our prize winner, Mr. Unlimited. He wants to know, you're talking about your levered ETFs. He says he didn't hear you mention HIMS or Cameco. Do you have any offerings on either of those two?
We don't have HIMS. There is one HIMS out there. I forget who it is. I do not believe there is a CCJ out there. I know CCJ has been filed. I don't remember who filed it. I do not think there's a CCJ out there. We have not filed for that. We have filed for HIMS, but we don't like being number two.
And Matt, looks like the rest of our chat is obsessed with debating the use case or perhaps lack thereof of AI in their trading. So they're not having a good experience. Maybe they need to hang out with Otto, sir. Maybe that'll improve their AI use case in their trading, sir, because they're not having good luck with the chat GPTs and others of the world, sir.
Yeah, I mean, our new Otto that we pointed at the ORATS data is quite impressive. You could ask it so many things, and it does have the ability just to bring in a lot to its answers, and we're getting a ton of usage out of it from our beta testers right now. So we have adopted the AI, and I think it's helping people find us. Chat loves us because we're using a lot of AI. And we're with the online, with our dashboard new Otto, you could really get a lot of information very quickly to make better decisions, Mark.
Yeah, that's the key at the end of the day, is what data can your AI plug into, right? And Matt's got great data over there, so Otto should be a little bit more well-informed than, let's say, your low-hanging fruits. I don't think Gemini will even take most of those questions. ChatGPT, unless you get even if you get the upgraded, the data set still cuts off. Certainly not useful we're talking about 0 day, and not useful for anything along those lines. We got the Queen chiming in here saying, most AI platforms don't have updated data, so they can't really answer trading questions yet. I've asked ChatGPT many different trading questions, and even Gemini, their data sets are terrible and outdated. Yes, that's exactly the point I was making, Queen, that the AI is only as good as the data that you're feeding it. And I think Otto might have a little bit better data set to munch on than some of these other ones out there, at least when it comes to what we're talking about here. I love when you folks derail me. It's always good stuff. But let's keep rolling here. Let's go out to Big G. He's been waiting for a while as well for his question. He says, I've heard you say that the collar is the holy grail position for financial advisors. Again, guilty as charged. I may have said that once or twice in the past. I would argue that it's the cash secured put. Great way to generate income and initiate equity positions at favorable levels. Do you agree or disagree with that assessment? Also, any tips or tricks from the pros for how you like to sell your cash secured puts? Well, I don't disagree. I think most of our audience, if you had to ask them what their go-to position is most days, it's a good cash secured put. So we're definitely fans of that. I just know from a lot of the advisors we've talked to and a lot of the use cases they need, a lot of them need hedging and a lot of them don't want to pay for it. So that's where the modified collar can really come in to be a benefit for a lot of them. But that said, tips and tricks for how to sell your cash secured puts. I would point you really quickly here before we keep rolling, Big G. We have talked about this obviously many times on the network. So if you want to check out some of our educational programming, like Options Bootcamp that we do every week with Dan, those are definitely taking a lot of deep dives into how to sell and structure your cash secured puts. We've also done it on this program. If you want to go back to the episode 133 from March of last year, we were talking about options income and our great volatility debate. Also, if you go back to the before times, September of 2019, episode 83, we had a great title of that episode, Naked Delta Cowboys, Hunting for Income. Say that 5 times fast. So we have talked about cash secured puts on this show more than once out there. I encourage you to check out the archives for how we like to do it. But that said, Matthew, Matt squared, it's getting me. Matthew, I've heard a little birdie told me you like to sell a put or two. What do you have to say here for our listener, Big G, wants to know any tips or tricks for how you like to set up your cash secured puts, sir?
Yeah, so I think it really comes down to whether you want to be put the stock or not. Typically, when I'm selling a cash secured put, which, it's probably my go-to strategy. Like I said, I buy a lot of calls as well, but I do love cash secured puts. So typically what I'm doing is I'm looking at the chart and I'm putting it at a level where it's highly unlikely that I'm going to get assigned the stock. And, I'm just trying to earn income on that position. And then I've got my calls where I'm looking for capital appreciation. So that's typically what I'm going to do, is just look for the spot on the chart where it's most likely I'm just going to earn that entire premium.
Mr. Matt, same question for you, sir. Big G wants to know any tips or tricks for how you like to set up your cash secured puts. And also, do you agree with his assessment that the cash secured put is, in his opinion, the holy grail for financial advisors, sir?
Well, you have to want to own the stock, and I still don't think you get enough for it. As a market maker, my thought process is always never be short units. And so I always like to do a cash secured put without having the cash, but finding another put that I could buy against it. Like, I just sold a strangle and XOP, but I bought a way out of the money strangle against it because you never know what's going to happen. So, it works, for a long time, but, cash secured isn't really a hedge. If you want to be put to stock, that's one thing, but I like to find a put against it. And that's my level of risk that I could take, Mark.
So you're more of a put spread guy rather than a naked quote unquote cash secured put out there. Yes, there's a lot of different ways to skin that onion, Big G. A great question. I don't think anyone here hates cash secured puts, just different levels of risk tolerance. And as we've said many times, the first and most important bit of due diligence you need to do when you're selling any put is, do I want the stock or not? That is the number one. If you say yes and you're truly comfortable getting the stock put to you, then you've kind of done your due diligence. You sold your put. Hopefully you got a decent amount for it. And if you get the stock put to you, you got it at a more favorable level, so you're happy. But beyond that, if you're looking to harvest a little bit of the old risk premium, that's where things get maybe a little bit more nuanced out there. We got time for, looks like maybe one more. Let's go to this one from another person who's been waiting for a while. Elio81 talked about selling puts. Now we're going to talk about buying them. He says, with so many RIAs choosing to go the passive route, how do you convince an advisor to spend the precious basis points to buy protection for their clients with options? Seems like most RIAs are just too conservative to be willing to give up any gains to manage risk. Elio, that's what I was saying earlier about the collar. That's one of the reasons why we've said the collar in the past is a great tool, especially maybe a modified collar where you're pushing the put out. You're selling near-dated calls against it, and you're also maybe selling a near-dated put, so you get a couple of different income streams. All of that geared around exactly what you're saying. RIAs don't want to pay for anything. So if you can reduce that outlay, that at least makes it a little bit more attractive for them. And you can also go the calendar route. A lot of interesting ways you could go with trying to mitigate the outlay for that put. But Matt, what would you have to say for an RIA listening to this? And maybe they're saying, I'll just buy a passive index and I'll ride it up and then unfortunately ride it right back down. How do you convince someone like that to maybe pay a few basis points for protection? You talked the HEAT acronym. The first part is hedging. How do you get people to pay for hedges?
Is that a Matthew or a Matt, Mark?
I'm sorry. I meant Matthew. There's too many Matts. M and M.
I know. It sounded like a good one for Matthew.
Yeah, a bunch of things there. So we're coming out with an ETF for this towards the end of the year. We're working with Goldman Sachs to design it. And the ticker symbol is OHNO, OHNO, for obvious reasons. And the idea behind it is to try to create a no-bleed tail risk, something that the 99% of the time the market is going up isn't killing you, so you get rid of it right before the market goes down. And, that'll probably be out, October, November-ish. In the meantime, I'll give people a couple of ideas that I like to use. One is selling uncovered calls on ARK. I think ARK is one of the worst ETFs out there. And from time to time, when the market just feels extended, I'll sell an out-of-the-money call on ARK. I did it the other day. I think ARK was at 72. I sold 82 calls. And worst case scenario, I end up short ARK 10 points higher. I'm up 50% on those calls right now, and I'm holding on to them. You could put debit spreads to reduce the premium. You could do ratio spreads to help reduce the premium. You can use 0 DTE SPY puts and do calendar spreads on those, which I do a lot. So there's a lot of different things you can do versus just saying, hey, I'm going to buy, a put on SPY, which in and of itself can be, fairly expensive from a premium standpoint when 95% of the time it's going to expire worthless. Obviously that can be tough for someone to do.
Mr. Matt, the last word is yours, sir, as we're coming up against it for that traditional passive RIA. Maybe he wants some hedging, but he's not really inclined to shell out for it. What do you do in that scenario? How do you get them to pay for a little bit of protection?
Well, as we know, nothing teaches you like history and pain. And so you just have to show them, I love back tests for that reason. You didn't have to be there, and you could see what would have happened. You could see what would have happened with that hedge on, and most people will get it from there. If you as Matthew was saying earlier, we have a whole new generation of traders that haven't seen much pain out there. And that's actually a little worrisome. So to end it on a worrisome note, learn how to hedge and look at graphs. Talk to people that have been there before, because it doesn't always just go up. And when it goes down, it goes fast, and there's a lot of pain, Mark.
Leave it to Matt to end us talking about the pain out there. So keeping us on an optimistic note. Unfortunately, that music means we've come to the end of another epic journey through the world of advisors and options. But before we go, Matthew, I got it right that time. Matthew, if folks are intrigued by all the stuff you're cooking up over there at Tuttle Capital, maybe they want to check out an additional podcast or two. Where should they go? What should they do?
Yeah, go to TuttleCap.com. You can sign up for our free daily newsletter, The Daily Heat. We talk about the heat formula. Usually something thematic, and throw some other things in there. We also have a podcast that we do, which you can get more information on the website about as well.
Whatever you do, don't check out that one with that Longo guy. He's the worst. I hear the worst thing.
That one was bad. We may have to take that one down.
Shut that guy up. Absolutely the worst. I would definitely skip that one if I were you. Check them out over there, listeners. Tuttle Capital, the place to go to kick the tires and light the fires. Also learn about what they have in their offering. So if you need more podcasts in your lives, there you go. Yet another offering for you out there. And Mr. Matt, we're getting a lot of questions in our chat about Otto. They are intrigued. A few people are asking if they can just head on over to ORATS and just try Otto directly, or do they have to sign up for an account? How does that work, sir?
ORATS.com has the Otto father, and ORATS, the dashboard product, has the young Otto that goes into all the data and everything. So you gotta get on the dashboard in order to ask Otto all these things, and you'll be impressed. That's our latest thing, Mark. That's our beta, and that's what's going on at ORATS.
They also are looking forward to bringing you on. We had that Vol death match not too long ago with Dr. Vix and Mr. Vixologist. They want to bring you and Henry on for like a data death match. I was like, I keep telling them you guys are buddies. You just did the panel together, but they want to pitch you against each other, Matt, in a death match for the ages. What do you say?
You have a very violent group of people in your place.
They do. They love conflict. Maybe we'll see. Henry's already agreed to a Vol death match. We just need a dance partner for him. We'll see. Maybe we'll be mad. We shall see out there. Unfortunately, we won't see any more Advisors Option, but we're not done today on the network, not by a long shot, listeners. We'll be back after the close to talk the latest addition to the network, of course, the Hot Options Report. You can see what's lighting up the options market every day over there. And spoiler alert, a lot of hot new names breaking into the top 10, which is always fun to see. You know, normally this time of year, not usually the sexiest from an overall volume perspective. So it's always fun to see some new names, not just entering the top 10, rocketing into the top 10. So check out the Hot Options Report wherever you get your favorite podcasts, or on a bunch of other platforms, you know, your YouTubes and everything else of the world. And then we're back again with our usual array of content until we're back again with another episode of the Advisor's Option. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's MIXLR.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.